Hello, everyone. Welcome to another video for standards, accounting standards. In this video, we will be actually looking at HKS 28, which is about accounting for associates. Accounting for associates. Accounting for associates is usually under equity method, right? So this video is basically going to look at the very specific part of equity method. There's a definition of what is an associate and everything that is explained in this standard. And if you would like me to make a video on that, please let me know in the comments below for the video. All right, so we will make a video on that too. But in this video, we will specifically be looking at the one component of equity method or accounting for associates, a very specific term called significant influence. So let's maybe look at. Let's first look at what is what do we actually mean by equity method and what that term significant influence actually counts for. So let's look at few definitions here. So what is an associate, right? So in the standard, they have defined what is an associate. So associate is an entity, or it could be an unincorporated entity, such as the partnership, right? So partnership is not a corporate entity over which the investor has significant influence, right? So this video will discuss significant influence in detail, but to explain, we will briefly look at some basic definitions. That is neither a subsidiary nor an interest in a joint venture, right? So the company's entity has a significant influence, but it's not a subsidiary or a joint venture, so it's an associate, right? I'm not going to look at these definitions here. Consolidated financial statements, control. Let's look at the equity method definition, right? So it is a method of accounting whereby the investment is initially recognized at cost and adjusted thereafter for the post-acquisition change in investors' share of assets, net assets of the investee, and then profit and loss, right? So this is the accounting. So this is the accounting method for associate. We call it equity method, right? So the whole standard is about that. I'm not going to look at other definitions, joint control or the significant separate financial statements. So let's look at significant influence. So they have briefly defined, the standard has briefly defined significant influence. So significant influence is the power to participate in the financial and operating policy decisions of the investee, but is not control or joint control over these policies, right? So significant influence is basically the investor has the power to participate in the financial and operating policy decisions, right? So investor is actually controlling any financial decision for its associate or operating decisions, right? So it's making decisions. So that's what a significant influence is, but it is not controlled, right? So this definition is not telling you much how to judge significant influence. What is a significant influence, right? So these questions should pop up in your brain by looking at this definition. It's not very comprehensive, right? So this is just an introduction to the definition. So paragraph from paragraph 6 until so if you look at until paragraph 6 until 10, so paragraph 6 until 10 tells you the definition of significant influence, and therefore in this video we will actually be only looking at what significant influence is, because in your QP examinations they can actually ask you just a simple question around significant influence only. So there could be many questions that would come from significant influence itself. Question who's writing your exam is smart enough to make questions out of a small thing, right? And there's a reason why there you have about five paragraphs explaining what significant influence is in this standard, right? So let's start and look at what the definition is on significant influence. So a significant influence, if an investor holds directly or indirectly, right? So it could be a direct or indirect, example through subsidiaries. So they have given examples as well. Indirectly could be holdings through subsidiaries, 20% or more, right? So it starts from 20%, right? So it has to be greater than or equals to 20% of control over voting power of investee, right? So that's actually, and then it's presumed, right? So that's another keyword here, presumed that the investor has significant influence. So in very simple terms, what it means is that if an investor has direct or indirect control, or a significant influence, not control, control is not the right word. So directly or indirectly, well, for more than 20% or equal to 20% of voting power over investee, it's presumed that the investor has significant influence, right? So it's presumed. There's a meaning behind that. So, like, you may not look for other factors. You may just directly see at the percentage holding, and you can just assume that it has significant influence, right? That's what it means. Now, conversely, they can actually have less than 20%, right? So they can have less than 20% voting power of the investee, and then it's presumed that the investor does not have significant influence unless such influence can clearly be demonstrated, right? So then that's the point where you would have to actually look whether the investor has significant influence or not. So if it has less than 20% of ownership, if the investor has less than 20% of ownership, it is still possible that the investor will have significant influence, right? So it's still very much a possibility. But then how, as an accountant, how you're going to judge that, right? So the standard basically has a guide on that. Standard actually has a guide on that, and they will actually tell you what factors you will look for. The existence of significant influence by an investor is usually evidenced in one or more of the following ways, right? So it's either one or more. So it could be at minimum one of them should be present, right? One of the factors should be present. So 7A says representation on the board of directors or equivalent governing body of the investee, right? So if someone as an investor, someone from your investors team is sitting at the board of directors or is in a position at higher management, who can control financial operating decisions, then and even if the investor has less than 20% ownership, it still has significant influence over the investee, right? So that's one way. The other is participation in policy-making processes, including participation in decisions about dividend and other distributions, right? So then again, these 2 points will go hand in hand. If one of your members is sitting at investees, higher management, and making decisions about financial and operating decisions, policy-making decisions, then of course it's likely that the company has significant influence and it's an associate, and the company may use equity method to account for that. Again, that's not necessary that the company will use equity method. There are other things that you will have to look for. Then bullet point C says material transactions between investor and investee, right? So now material transactions could be anything, right? It has to be material transactions. And then part D, interchange of managerial personnel. So you see there's a lot of, so this is basically purely operational, right? Purely operational. So they have, they are exchanging managerial personnel in between your investor and investee. Then provision of essential technical information. So let's say as an investor, you are actually providing your investee with some technical information, which actually is guiding their financial performance, investee's financial performance. So again, that shows that the company has significant influence. The investor has significant influence over the investee. Then paragraph 8, 9, 10 again are elaboration of what other ways, what other would be considered as control of significant, not controlled significant influence. So potential voting rights as well. So in this paragraph, they've actually talked about potential voting rights here. So you can read this paragraph on your own, but if I summarize this paragraph for you, it says basically that even if the investor has potential voting rights, they will be considered when assessing whether the entity has significant influence or not, right? So you have to consider, so as an accountant, you will have to look for if the investor has potential voting rights over investee. That is one of the factors that will be considered when determining whether the investor has significant influence or not. Then in assessing whether, so there's a further assessment for potential voting rights, right? Whether they contribute to significant influence or not. Those factors will be terms of exercise of potential voting rights and any other contractual arrangements, whether considered individually or in combination. that affect potential voting rights, right? So they have further elaborated on how you need to consider potential voting rights, how they will have an impact on significant influence, right? So one factor that they clearly mentioned was the term of exercise, maybe duration of the exercise, and any other factor that could actually help assess potential voting rights. Then bullet point 10 says an entity loses. So it also talks about what are the scenarios when entity loses significant influence, right? So when entity loses significant influence over an investee, when it loses the power to participate in financial and reporting policy decision, right? So the key thing here is the key thing here is influence over financial / operational policy making, right? So you'd have to consider whether the investor has control, whether not control again is not the right word in this case actually, whether the investor has influence over financial, right? So even the influence over financial and operating policy decisions of that investee. The loss of significant influence can occur with or without a change in absolute or relative ownership levels, right? So ownership levels is just one criteria for assessing significant influence. So if the investor has more than 20%, or 20% investment in an investee or an entity, then of course a standard says that you can presume that there's significant influence. But if that is not the case, if the investment is less than 20%, then actually as an accountant you will have to look for whether the entity has significant influence or not, right? So the key thing here is to look for whether the company has, whether the investor has influence over financial or operating policy decisions of the investee. Right, so so they've given an example here. It could occur, for example, when an associate becomes subject to the control of a government code, administrator, or regulation. It could also occur as a result of contractual agreements. So they have just given you examples here, right? So ownership is not one criteria. There are other criteria that we have talked about in this video, and the standard talks about from paragraph 6 to paragraph 10. You can of course read them on your own. And I highly recommend that. But the key takeaway from this video is that an investor will have significant influence if the investor has influence over financial and operational policies or decision making of that investee, right? And I would try to make a video on few examples for that. If you would like me to make a video on that, please comment down below, and any other topics that you would like me to make a video on. So you can comment down below. If this video was helpful to you, please don't forget to like and share with your friends, and subscribe to my channel for more videos like that. Thank you very much for watching this video. Thank you.